In East Africa, business activity expanded in December as a result of rising domestic demand that spurred production, hiring and purchasing by companies. CFC Stanbic Kenya's Purchasing Managers Index rose to 55.5 last month from 53.7 in November. Now, 50-point reading denotes growth in business activity. Anything below that denotes a contraction. The PMI is one of the indicators watched by the Central Bank's Monetary Policy Committee. Now, this quarterly average was, however, the weakest since Stanbic Kenya PMI started being recorded in January 2014. Let's talk to one of the authors of that report. Gibran Qureshi is an economist at the Global Markets Group in Standard Bank. Of course, that trades at CFC Stanbic in Kenya. He's live in studio with me right now. Gibran, interesting report. In November, we had an upturn and that continued and accelerated into December. Where was the recovery most concentrated?
Thanks, Rama. Yeah, I think when we look at the CFC Stanbic PMI closely in December, the recovery was mainly from the construction sector, but also some part of the services sector remained quite robust. But looking specifically at the indices, output, new orders, and employment was rising quite robustly over the last month or so. And I think these are pretty encouraging signs, given that, as you alluded to in your introduction, the survey hit a record low of 51.7 not too long ago in October. So this recovery hopefully will gather momentum as we go on.
Indeed, but looking forward though into 2016, inflation essentially peaked at a year's high, levels we haven't seen in a couple of months in December. Food securities are concerned. So what are the odds of this trend, this strong growth carrying through into the first quarter of the year?
Yeah, I think that's a very good question. So if you look at, the first quarter in 2016, obviously we are expecting some poor weather conditions, perhaps an extension of the El Nino weather rains that's going to damage a lot of crop production. I think the agriculture sector will perhaps not fare too well in the first quarter, but we are quite confident that activity in the construction sector will continue to drive the PMI and perhaps, keep it at a robust level of around 55 or 56 in the first quarter.
Indeed. Let's talk about public debt. We've got roughly $6 billion or so worth of domestic debt that's due to mature somewhere in the course of the year. And that's in addition to the relatively expensive debt the government took on in the third and the fourth quarters last year. Does the government have much room to accept much lower rates in the second half of the fiscal year?
I think the tipping point for domestic borrowing and money market rates will really be the supplementary budget or the budget policy statement that typically is announced at the end of Jan or early Feb. I think, if we do see a slashing of the domestic borrowing target, I think there will be some respite for interest rates around that time. But, if austerity measures aren't imposed, there could be a very bumpy ride ahead for interest rates. And as you correctly mentioned, specifically given that there is a huge refinancing risk in 2016 for the government. But looking at the strategy that they have adopted, they do seem to be inclining towards issuing more external debt, perhaps looking at another syndicated loan, or when global liquidity conditions improve somewhat, perhaps also looking at issuing another Eurobond.
Indeed. The Monetary Policy Committee meeting is happening on the 20th of January. That's barely a week away. Inflation, of course, breached the central bank's target in December. Given the balance of factors here, where inflation is, where the Kenyan exchange rate is, or rather the shilling-dollar exchange rate is, what do you expect to come out of that meeting?
We expect no change at the meeting on 20th of January. I think, looking at the inflation numbers, it wasn't, a big surprise to us at CFC Stanbic that headline inflation was actually going to breach the upper band target of the government. When you look at, base effects, that was going to really, head the trajectory higher. But of course, a lot of that pressure has come from food. And I think the central bank will probably not tend to react to exogenous shocks, because if you do raise interest rates, that's not going to bring down food prices. So I think they're perhaps going to take heart in the fact that imported inflation from the secondary round effects of the currency are muted at this point in time.
Indeed. We'll leave it there for the time being. As always, thank you very much for your insights. That's Gibran Qureshi. He is, of course, an economist at the Global Markets Group in Standard Bank. It trades in Kenya as CFC Stanbic.